welcome to ClearCast, episode 43. We are heading towards the Corvette buying stage of our journey at ClearCast, I'm always amazed that we're continuing to march on here. But we're so excited today to have a very distinguished guest. But before I get to introducing him, I would also like to introduce our guest host for this episode, which is Dan McAllister, who is our VP of Product Management at Clear Capital. Dan, I'm so glad that you get to do this with me.
Thanks for having me on, Keenan. I'm happy to be on the midlife crisis episode.
So Dan and I are going to team up, getting to know someone that that many of you listeners know really well, which is we have Lyle Radke here today with us. Lyle Radke is the principal of Collateral Policy at Fannie Mae, and I think his title just changed recently, so maybe we can ask him about the new role. But he's responsible for communication of principles and solutions through written media, such as selling guides from Fannie Mae, as well as public speaking. He engages with industry counterparties, including technology teams, lenders, vendors, risk investors, and regulators to share Fannie Mae's vision and implement new ideas. I like to call him Professor Radke because I always learn something when he speaks. Lyle, welcome to ClearCast.
Thank you, Keenan. Dan, great to be here. Thank you.
So, let's start a bit, assuming that we don't know you. And actually, I've never had the chance to really ask you this question, but tell us a bit about, who you are and what led you to Fannie Mae. What was the journey?
Well, I am an appraiser by trade, and I have a master's degree in geology. When I completed my degree, I had recently gotten married, and I was getting the U.S. was in a little bit of a recession, so commodity prices, oil, gold, copper, they were all kind of low, and companies were not hiring geologists full time. I was getting kind of spot gigs, or I'd go out and work on a project for a few weeks, and then it would end, and I would be looking for my next project. And my wife said, "Lyle, you really need to find a real job." And she said, "My uncle is a real estate appraiser. His business is booming. He needs help. You should talk to him." So I talked to her uncle, and he gave me kind of a tryout, and I really loved it. And so I became an appraiser. And being an appraiser is a little bit like being a geologist. The sort of the basic approach of there's a property that you want to look at, you want to gather as much information about it as you can, and then you're going to assess its potential and write a report to your client about the potential of this property. I mean, that's what geologists do, right? And that turns out to be what appraisers do also. So I had certain advantages coming from a science background. I've always approached appraisal problem from a very data-centric scientific perspective, and I was comfortable writing reports and comfortable interpreting data and using spreadsheets and that kind of thing. So I found it to be a really natural fit. The only thing I needed to learn was, the mechanics of the housing economy and a little bit about, the housing itself. And then, after that, it really was a great fit for me.
Super cool.
So I could tell you a little more then. So how did I get from being an appraiser
to Fannie?
to being at Fannie Mae, right? I worked for my wife's uncle. I worked with him for about 9 years, and it was great. He's a great mentor, a great friend, somebody I respect immensely. But I felt like there's certain aspects of the fee appraisal business that were not really for me. So a lot of interaction with, say, in a kind of a sales sense. This was 2002, 2003. Subprime was getting ramped up. We were finding it harder and harder to get paid. Weird assignments like there's some things that I was like, I'm tired of this, right? And so I was looking around for a way to apply my skill set in a different setting, and I saw an advertisement for a loan servicing company in San Diego, California, that was hiring review appraisers. So I applied for that. I got the job, and I started working for the bank, right?
Hmm.
And I worked there for about 10 years. And so from 2003 to 2013, and you know what happened in 2008, right in the middle of my tenure, right? So a couple of great things happened there. One is I've really got a great education on risk management. In servicing valuation, you see all the strange properties, you see all the problem children, you see the things that went wrong after the loan was originated, right? And sometimes the root cause was in the origination appraisal. So, and you see a lot of properties. I'd see sometimes 40, 50, 60 properties a day. Whereas as appraising, you might see 2 or 3 a day, right? So really a great education for me in terms of the consequences of appraising, what happens after the fact, and what kind of problems you might run into if you don't do it well from the lender's perspective. The other thing that was really important for me during my time at the servicer is we started off in 2003 with kind of a paper-based approach. And a little funny story, that we had some secretaries, some support staff who would every day they would print out all the appraisals we would receive. They put them in a stack, right? Then they put a sticky on that stack. The sticky says August 28th, meaning they printed it on August 28th. So we were expected to go to the oldest stack and draw off the top and review that.
Wow.
Well, so there was no control and no accountability. Things could get lost, and nobody knew who had what. And if something did get lost, no one knew that it was lost until somebody else downstream finally complained. And so we felt like we wanted to build a digital platform, and we started working on building a digital platform. We put out bids, and I was the subject matter expert in working with the company that built our platform. So I got immersed in the technological aspects of product delivery and quality control, and that was really a great experience for me. So fast forward a few more years, and in about 2010, 2011, the company that we had chosen to build our platform won the bid to build the UCDP, the Uniform Collateral Data Portal. And Fannie Mae started talking with us and interacting with us a little bit about our process and our technology and the outcomes, because we had really clean QC results on our appraisals, and they were wondering how we did it, right? So we had a chance to kind of get to know the Fannie Mae folks. One of my co-workers, co-equal, I was at this point in time, I was managing the servicing valuations, but I had a peer who was managing the origination valuations, and he went to work for Fannie Mae. And a couple of years later, he called me up. He said, "Lyle, we are getting ready to launch this fantastic application, and we need help. I think you'd be great at this." And so I looked into it, and I applied for the job and got the job, and that led to me being part of the team that rolled out Collateral Underwriter at Fannie Mae. So that was a great experience also.
Gotcha.
Fun fact is, when I was a budding valuation quality analyst kind of leader at Clear Capital back in like the 2010, 2011 timeframe, one of my very first business trips was to go visit Lyle. And Lyle probably doesn't remember this, but was to go visit Lyle down at his office, and I'd learned so much of the baseline of like how to think about measuring quality and measuring our performance came from learning from Lyle back before he was at Fannie Mae.
Wow.
We had a strong focus on metrics and scorecards and performance.
Scorecards,
right?
Exactly. Yeah.
Yep.
Good. Now's your chance to grill him then.
Yeah, we had Clear Capital was one of our vendors at the time, and we had a great relationship. So
that's
very
great.
collaborative.
Very cool.
So then, so Lyle, since you've been at Fannie Mae, you talked about rolling out BU. What are the things you've been working on recently? What are the things you've been particularly proud of helping to roll out within Fannie Mae?
Well, of course, the rollout of collateral underwriter is like it's a career defining moment. It's one of the great things
Mm.
that I've been part of here at Fannie Mae. Since then, we have we've seen this journey towards being data centric in the collateral space really start to mature, and with that came some new ideas and some new opportunities. One thing that I thought was important and that I really championed here was that there was no standard for developing a gross living area or square footage of a house, not in a policy sense. And when I first started in the business, there was a standard. We all followed the FHA guidelines, but FHA retired that portion of their guidance back in about 1996 or 97. And so the old timers, most of them still followed the FHA process, but newer people didn't necessarily do that. And what we noticed is that there's a lot of disparity in how appraisers approached the square footage question. And if you're going to do good analytics, you need to have consistent data in the first place, right? So we looked around at the different options available, and we felt like the ANSI square footage standard was the best option. And so we adopted that by reference as a matter of Fannie Mae policy. And that was really important, not only for appraising, but for some of the things we're going to talk about today. For example, for automated floor plan calculations. Okay, your coders need a standard to aim for, right? And for property data collection, you're talking about people who aren't necessarily appraisers, and you need a professional standard for them to be trained to. So it turned out to be really important, I think, for the industry. And now we've seen others in the industry. Freddie Mac has adopted it, and other third-party investors. And so I'm really proud of that. I felt like we showed leadership, and it's making a difference.
So I mean that is a good segue into, like, one of the major changes that's really um, come out over the past few years, which is this the idea of property data collections, inspection-based waivers. Um, this is probably the most change we've seen in the appraisal industry, probably in the past 5 years, and we've seen in the past 20 years, perhaps. In terms of the speed of of new options and approaches. Give us a sense of the why is Fannie Mae exploring other options other than the traditional appraisal approach, and certainly touching on a bit on the idea of data standards, beneath that, if you're going to expand to these different options, besides the traditional, what we know as kind of the traditional appraisal approach, how a standard's been a part of that.
Yeah, I think with any technological revolution, there is there are there's a disruption that takes place, right? And if you think about, let's say something as fundamental as the automobile, right? Uh, when Americans first started driving automobiles, it was a luxury item. Most people were still using the horse and carriage, right? And then the Model T came out, and all of a sudden it was available to the middle class, and it became more common. And pretty soon, by like the 1920s, a lot of people had cars. But there were there were a bunch of things that society had to work through, like automobile crashes. Lots of people died, and society said, you know what, we need traffic laws, stop signs, speed limits, right? And then this continued to mature in terms of safety features for automobiles, in terms of driver's licenses and training, It took us a long time to become mature, and then we started to think about, environmental impacts. Well, let's get the lead out of the gasoline. Well, let's make the cars more fuel efficient, right? So the invention of the automobile was not the end; it was the beginning, and it disrupted transportation as we know it. And those disruptions create ripple effects that kind of work their way through society over time. And I think, for all our small little part of the world, which is valuation, residential property valuation, I should say, for mortgage purposes, the UAD and UCDP, that combination UAD, UCDP, and CU was that disruption. Like it changes everything, and we're still working through those ripple effects. So I think as we, as a business and as a profession, as we observe what has happened so far, we start to feel like, there's this new emerging question. There's this new emerging opportunity. Could we do things differently? When you have digital data, what can you do with that data, right? And so I think our motivation is, first of all, we have a mission, and our mission is to provide liquidity to the mortgage market. And so we want to fill that mission well. But in filling that mission and operating in a safe and sound manner, what can we do with this tremendous data source, which is the appraisal data, and how does that change maybe our operations? And so we're just kind of feeling our way through this, just like anybody else. Now we do have plans. We have 3-year plans and 5-year plans and things we want to do, and I can't necessarily tell you everything that we want to do, but it's all grounded in this real disruption that happened through the UAD, and in creating a whole new way of looking at collateral risk.
And Lyle, is like, I think this has taken the form in the industry of appraisal modernization, right? And it's a pretty broad term, and I think a lot of that kind of officially kind of felt like it kicked off maybe 2017. As we cut to 2024, there are new programs out there. There's alternatives to the appraisal, inspection based appraisal waivers being one of them. Like, can you maybe unpack a little bit of how we've evolved to get to that point? How, to start, like you talked about, this ripple effect of standardization, but also technology that's emerged over the last several years, that has kind of built the building blocks to kind of some of these new programs.
Yeah. If you look at the Uniform Standards of Professional Appraisal Practice, USPAP, which is the defining standard for appraisers, the definition of an appraisal or an appraiser is an appraisal is an opinion of value. An appraiser is someone who develops an opinion of value by following a professional standard, professional process. So when you look at what the GSEs, Fannie Mae in particular, what we've asked appraisers to do, when I first came into the business, my mentor said that, we're the eyes and ears of the lender. And I've heard that many times. Being the eyes and ears of the lender is not the same thing as developing a professional opinion of value. And I think the lending industry kind of took advantage of the appraiser as someone who was out and about in the community and who they could put additional tasks on. And so we've relied on appraisers for things like getting descriptive information, which is not an appraisal task, right? It's a necessary input, but it could come from a lot of different ways. It doesn't necessarily have to come from the appraiser personally making observations. And assessing property condition and property repair. Boy, every appraiser is asked to rate the condition of the property, and then most appraisers have a disclaimer in the report that says, I'm not a structural engineer, I'm not an expert on this, right? But I'll give you my opinion anyway. And then assessing property eligibility. So from a lending perspective, for example, Fannie Mae won't buy loans. Our single family business won't acquire loans that are secured by, let's say, 5-unit properties. So someone's got to count the units, right? Well, let's have the appraiser do that. They're going to be in the property. They can count the units. Well, how do you define a unit? What counts, right? So then we've burdened the appraiser with a bunch of tasks that really aren't their core definition of what the profession does. Now, I think appraisers, do some of that thing very well, but structurally, it's fair to ask the question: is that the only way to do it? Is that the right way to do it? Why are we asking our valuation experts, our market analysts, whose highest and best use is to analyze the residential housing market? Why are we asking them to do these other tasks? And then I think you combine that question with what we started to observe back in 2016, 2017 is some new emerging technology. We started to hear and see some demonstrations of really digital capabilities for gathering property data. We started to see use of LiDAR with cell phones and other devices that could be then converted into sort of a geometric calculation of the size of a property. So some really interesting confluence there of technology, and at the same time, we're asking ourselves fundamental questions about the role of the appraiser. Mm-hmm. Now, fast forward a little bit, and we started a pilot where we said, well, what if we didn't ask the appraiser to do all this other stuff? What if we asked the appraiser just to focus on their core competency, which is market analysis? And this was in 2016, and you'll remember we had a dip in interest rates due to Brexit, and refinancings were volume was what we thought was very high at the time, right? And so appraisers were very busy. Appraisal turn times were long. Part of our role, our mission that Congress gave us, is to ensure liquidity in the marketplace. And if you have to wait 8 weeks for an appraisal, that's not a liquid market, right? Mm-hmm. So we're trying to solve that problem, and we're like, well, if you could get that limited supply of appraisers to really focus on their core competency, feed them the data, and just let them analyze it, maybe you could save some time, maybe you could shorten those timelines. And so that's what we set out to do in our pilot. And essentially, we looked at a variety of different professionals, labor sources, you might say, to see whether or not they could take technology, take their own training, go to a house, do the physical description aspect, and then take that information, hand it over to an appraiser, and see and have the appraiser do like a desktop appraisal with that information.
Yeah, I mean, change in any industry or profession is hard, right? I mean, you mentioned the evolution of the auto, the industry, and there's good reasons for each one of those changes that happened, but there's also probably resistance at different steps of the way to say like, well, is the benefit really there, as opposed to the disruption might be caused by that further evolution, of the change. And I'm curious, from your perspective as an appraiser, like how did you get comfortable with some of these things moving from underneath the purview of a professional, of an appraiser that's a professional at understanding, making these observations, as part of their process, to saying, okay, technology can now make some of those observations, or at least gather the data, if you will, or maybe it's a different workforce. I mean, you seem to have gotten comfortable with it as an appraiser, even though that's a pretty big change, transformative in some ways. How'd you get there?
Well, I'm again going back to my roots in science. Couple of different anecdotes, right? One, I love planetary science, and I was reading about one of our Mars rovers and how it was drilling a rock on Mars and analyzing the chemical competition of the rock. And I used to do this when I was a grad student, the same thing that the robot was doing, only on Earth, not on Mars, of course. And I just thought to myself, we can send a robot 50 million miles away to Mars, and it can analyze the chemical composition of a rock on Mars and send it back to us with great precision. And yet I'm looking at data showing that I send two appraisers to a house and they come up with different square footage and different values. And it just seems like that's not right. We should be able to do better, right? Why can't we do better? Why can't we get more consistency, more precision, more transparency? Uh, and so, that sort of drives my thinking is we want appraisers to be successful. Like, appraisers are really important partners to us. They do have this core competency, which nobody else has, which is the market analysis. And we want this to be right. We want it to be accurate. We want it to be consistent. We want it to be transparent. We want it to be reproducible. If you send 10 appraisers, they should get the same answer. And then if you follow that loan through its life cycle, that should turn out to be the right answer, which drives loan performance, right? So that's how I get comfortable with it is I look at data. And I look at data in terms of loan performance. I look at data in terms of appraisal consistency and appraisal performance to benchmarks. And I see, the things that appraisers do well. I see the areas of opportunity. And then we're looking at, technology and technology partners to try and drive that opportunity. Now, there's spaces where what the data shows is that appraisals don't really improve the loan performance over the long haul. And some of those are, I think, pretty obvious. Like let's say I last refinanced my house in 2011, right? So I'm paying and I refinanced into a 15-year mortgage. So I've been paying on a 15-year mortgage for 13 years. I only have 2 years to go. Yay, we're going to have a mortgage burning party, right? Well, let's say that, it's 2021 and interest rates have hit all-time lows. And I'm just thinking, man, I've only got, 5 years left on this mortgage, but I'd love to be paying a lower interest rate for that 5 years, right? Or maybe I'd like to spread that out for 10 years because I'm putting kids through college and I'd rather have my cash flow for college, right? So I refinance. What does it matter what my house is worth? Like, I've got 80-90% equity in my house. And if I get an appraisal, I might be able to pinpoint that. Maybe it's 78% or maybe it's 83%. But who cares? The loan performs exactly the same. Like, I don't need to know the value of my house in order for that refinance to be a good decision for me and a good decision for the lender, right? And we can use automated tools to say, oh yeah, Lyle, your value is somewhere between X and Y, and your LTV is somewhere between A and B. But in my case, it doesn't matter what the answer is, right? The loan performance is going to be the same regardless. So in that case, that's a situation where we, Fannie Mae, would offer an appraisal waiver, assuming we can establish some other things, right? So there's some other risks that we're going to look at. And I think just looking at data, looking at an understanding of the life cycle of the loan, a lot of things that I've learned here at Fannie Mae, things I learned previously at the bank, it helps me to get comfortable with this idea of an appraisal as a tool. It does a fantastic job of managing risk in certain scenarios. It's not the end-all only tool for managing risk because risk is a spectrum. It's different for different loans, right? So you have to pick the right tool for the scenario.
And so, Lyle, you started talking about appraisal waivers where there is no appraisal, and obviously, like the pure appraisal waiver really started to pick up some steam in that post 2016, post 2017 is kind of when those were launched. But it took a little time even for those to be adopted, but obviously played a big role in kind of the booms that we saw in 2020 and alleviating some of the pressure on the appraisal business. But let's maybe talk a little bit about the newest program that Fannie Mae has rolled out in terms of value acceptance plus property data. So, like, what is value acceptance plus property data? How does it fit with the pure appraisal waiver and the traditional appraisal? and kind of why has that arisen as a new solution?
Well, let's start with value acceptance. Value acceptance is our brand name for what is commonly called an appraisal waiver. We prefer value acceptance because waiver sounds like you're waving a magic wand and your risk management is going out the window, but that's not what we're doing at all. What we're doing is the lender comes to us with a proposed value. This could be something they get from the borrower. The borrower says, hey, I think my house is worth X, right? Or could be that they're running some sort of AVM, or they have, historic data on the house. We don't tell them where to get the number from, but they put the number into our desktop underwriter system, and desktop underwriter consults our database, and we assess whether or not, number one, whether or not we've seen this property before and how recently. And then number two is we assess the market and whether or not we think that value is consistent with what we would expect in the marketplace. And if those answers are yes, then and also we've got some buffer, so we've got LTV limits, we've got some kickouts for scenarios where we really feel like we need a more certain answer that we could get from an appraiser. But if it passes through all those checks and kickouts, then we'll offer this value acceptance. Now, one of the big buckets of kickouts is if we haven't seen that appraisal or that property recently. And so the question is kind of like, well, do you know that the house is still there? Might it have burned down? Do you know that it's being well maintained? Could the roof be bad? Structure? There's all kinds of possible things that could go wrong with the property condition. And so we look at data. We look at a lot of data and a lot of loan performance, and we look at how recently we've gotten eyes on that property. And we have sort of a risk matrix of where we feel confident that we know the property is, very likely to be in good repair, acceptable condition for our lending programs. And in those scenarios, that's part of the value acceptance logic. But in some cases, that's the missing piece. Like, we could be very comfortable with the value and the loan and all the other kickouts, but we might say, well, we just haven't seen this property recently. Or maybe the last time we saw the property was right before a hurricane or a wildfire. We want to know whether or not the house survived that, right? Or maybe there's another scenario where maybe the last time we saw the property was an appraisal that was subject to repair, and we never got confirmation that those repairs were made, right? Mm-hmm. So in those kinds of scenarios where we don't really have a high degree of comfort that we know the property condition, or that we feel like there's some serious condition risk, then this value acceptance plus property data is like fresh eyes on the property. We're going to be comfortable with the value, assuming that the property is in good repair and that we have a reasonably good description of that property. And so that's what we do. We tell the lender, you've got to have someone go out to that house, gather a description, send it back to us, and then assuming that description doesn't show any structural defects or any reasons why this property would be ineligible, then you're okay to deliver without an appraisal.
With these options now available, so value acceptance means there's no new appraisal needed at that moment, right? So the lender is not incurring those efforts, as well as the end the appraiser. There's an appraiser involved. Then you've got value acceptance plus property data, where there may or may not be an appraiser involved, but there's less a scope there. Do you think we're closer to the point where the risk of another 2016 8-week appraisals, that we're in a better spot? We're right now we're in an interesting place where we've had higher rates for a while. We're expecting maybe to see some rate cuts later this year. So at some point, there's going to be a pretty good set of loans that would benefit from refinances again. How do you think these programs have helped us in terms of preventing what happened before and in the future. And maybe dream a little bit. Do you see that that's some other possibilities of where appraisals could go in the coming years to continue to address that?
Well, it is a cyclical business. It's anybody's guess when the next, heavy refinance cycle will be. But it has happened, 100 times before, and it'll happen again. And so, yeah, part of what we're doing here is preparing for the next busy time so that we have options to ensure liquidity. I think also there are some other benefits more immediately. In order to get a value acceptance and value acceptance plus property data, the lender, the borrower, they have to sort of manage their expectations. Like they're more likely to get the waiver if they have a lower expectation of value. And of course, from the loan guarantor's perspective, from Fannie Mae's perspective, higher value estimates are more risky. Value inflation is one of our biggest risks. It's possibly our biggest collateral risk. So these programs work in opposition to value inflation. They encourage more modest expectations around value. And that's one of the things that we like about them.
So Lyle, you mentioned on with property data collection and the value acceptance plus property data, that loans where you haven't observed that property in a while, those are the ones where you get more comfortable with the risk if you can understand the condition and the features of those properties. So when practitioners go out and do property data collections, do they just collect whatever they want, or are there standards, and how does that piece work?
Yes. So we had a pilot program beginning in 2017 where we worked with lenders and some technology providers, partners, and ClearCapital was one of them, in a pilot program where we did just that. We had people going out to the property and making observations, and we, from the get-go, we developed a standard, and it was a proprietary Fannie Mae standard, where we said, we want you to collect exactly these data elements, and we want you to collect exactly these pictures, right? And these exhibits. A floor plan is one of the exhibits that we require. So from 2017 until today, that pilot has, there have been something like 300,000 loans go through that pilot. And in operationalizing all those loans and just in monitoring and looking at the outcomes, that that standard of what data we want collected has gone through a series of iterations. And we reached version 6 last year, sometime early last year, right? We launched version 6. So 6 iterations where each time we kept getting a little bit more refined. Now, it turns out that Freddie Mac ran a similar pilot, probably not quite as long as we did, probably not quite as much volume, but they began doing a similar pilot at some point, and they had their own data standard. And at some point, we sat down and we said, you know what, the industry would be best served if we aligned our data standards so that one property data collection would be fungible to either GSE, and that would allow the whole industry to rally around this one particular data standard. So we spent a good, a little less than a year working with Freddie to resolve any differences between our respective property data standards. And then middle of last year, we issued what we call the Uniform Property Data Set. So it's similar to other mortgage data standards. There is one for appraisal called UAD, Uniform Appraisal Data Set. And it's like the UPD is almost like a subset of the appraisal data. So the appraisal data includes all of the descriptive information of the subject property that we want, plus all of the market analysis and comparable data that we want. The UPD doesn't involve value, so it doesn't involve market analysis. So it's just sort of a subset of the appraisal data. Now, this starts to get a little complicated, though, because The UAD was the appraisal data set was launched in 2010. And so it's 14 years old. And technology has changed a lot in the last 14 years. Our Uniform Mortgage Data Program, under which all of these data standards reside, is aligned to the Mortgage Bankers Association's data program, which is MISMO. So the MISMO standards and the UMDP standards are aligned. We work with them to align so that the whole mortgage industry, it can look to just one set of data definitions, right? And so we began several years ago working on an update to the appraisal data set because it's starting to age, right? And it's not keeping up with MISMO, and it's not keeping up with technology. And we had published a new appraisal data set in 2023, but this is the appraisal data is hardwired into most lenders' platforms. So it's going to take several years for lenders to adopt it, to build the technology that they need to adopt this new standard. So we expect the new standard to go live next year, 2025, and then mandatory adoption across the industry in 2026. Well, the UPD, we were ready to go right now in 2023, right? It was done. And the technology was basically in place. So it's actually out ahead of the appraisal data set. What you see in the UPD is kind of like a preview of what you're going to see in the UAD in 2026.
Which has, I mean, you know, I'd like to turn some of the focus to who we're all hoping this has the most benefits for, right? Which is the actual home buyers and homeowners, thinking about the mission of Fannie Mae and what are why do we bother getting appraisals? Well, so that there's to your point, liquidity and options for homeowners to be able to finance right home purchases and when you think about all these standards, data standards that are happening behind the scenes, these different options, it, is there challenges that home buyers are experiencing today that these will help solve and uh and what else is being done, I think, by Fannie Mae in terms of appraisal to kind of think about improving the experience for the home buyer?
Yeah, I think for the home buyer, there's two challenges, two considerations. One is what I would call speed to certainty. And I'll use this example. If I were to go into a car dealership and let's say used cars, right? Just to complicate things a little bit, and I want to buy a used car. Um, there's something called Blue Book, Kelly Blue Book, which you could look up the price of the used car, and there's a number of other pricing calculators that you can look up online. I can personally get an answer for free on the value range of a used car, right?
Mhm.
And then if I go into a dealer and I make an offer on a used car, they can assess my credit very quickly. And so I can go into the used car dealer, and in 2 hours I can drive off the lot with my car that I own and
Mhm.
and with financing for that car if I wish to borrow money, right?
Mhm.
And cars can be expensive. Like some new cars cost 50, 60, $70,000. Now that's not as much as a house, but it's as much as a house used to be, and it's a lot of money, right? And it's
Mhm.
portable. Like I could drive down the road and crash that thing and ruin it on my way home from buying it, right? So there's a lot of risk for the lender as to whether or not their collateral is really secure. There's a lot of risk to me as a borrower as to whether or not I'm paying the right price.
Mhm.
And yet our car market really functions very efficiently, and it does so very quickly. And because it's using data very effectively.
Mhm.
Uh, Fannie Mae in the credit space, we have options for borrowers. So uh, if you're applying for a loan and the lender intends to sell that loan to Fannie Mae, they've got guidelines on what we require for credit underwriting. And for some borrowers, we may just need pay stubs for a period of time. And for others, we may need tax returns. We've got a range of possibilities in terms of credit score. We've got a range of possibilities in terms of savings or reserves or down payment, right? So all of these things present optionality to the borrower. If you've got a high credit score, you might not have to bring as much, have as much reserve. And if you've got, less steady income, you might need to bring more income documentation in terms of longer history and what have you. So trade-offs that really target the risk of the specific borrower in that specific transaction. We haven't had that in the collateral space. And again, as part of the disruption of having this digital data in collateral and appraisal, we can start to think about those kinds of questions. What are the trade-offs? And the benefit to the homeowner or the borrower is, again, think about this in terms of credit. If all you tell me is, Lyle, I just need a couple bank statements, that's much easier than, Lyle, I need 2 years of tax returns, right? If you tell me, Lyle, we've looked in you shared your savings account information with us and you have enough reserves, that's a very easy thing, right? But whereas if I don't have enough reserves, they're like, you got to save money, you got to move some money around. So the answer is tailored to the scenario. We can start to do that in collateral, where we can say, okay, we're comfortable with this aspect, but not necessarily that aspect. Let's get precisely what we need. And that saves the borrower time and money because they only have to provide or provision the thing that's missing or answer to the specific risk. So savings of time and money and convenience, that's part of the benefit for the borrower. Also, I think appraisal quality has improved and we hope will continue to improve through the use of data and metrics. So that helps the borrower because they have a better, if they do end up getting an appraisal, that answer will be more certain. They can rely on it with more confidence. So I think all of those things help the borrower. Cost savings, time savings, speed to certainty. Nothing's more disheartening or challenging for the borrower than not to have an answer, right? And they have limited patience. We live in a consumer society where everyone expects to get what they get now, and you're waiting weeks and weeks and months for an answer. That's very challenging both for the borrower and for the lender. So allowing options that create speed is also important.
Yeah, we're still in a constrained supply environment. It's obviously it's a bit better, but people still are competing for offers. They're still competing to and that
When I
uncertainty of
say
knowing.
speed, though, I'm not necessarily talking about like the amount of time it takes to get an appraisal. Typical appraisal might take 5 days right now. In 2021, it might have been 4 weeks, but the question of speed is not really how long it takes to get an appraisal. It's how long until you have a certain answer in terms of your lending decision. And again, back to the car example, I go into the car dealer, in 2 hours, I have a certain answer. And it's a big financial transaction. What's the right timeline? How fast can we provide certainty both to the lender and the borrower in terms of the decision?
That's good. Well, it's been awesome. I'd love to maybe have you leave us, Lyle, a bit with, anything in the future that's next on the docket. I know there's a lot of hard work going on. Already looking into 2025, but what can we expect later this year or next year that you want everyone to know about?
Well, certainly we intend to continue to dive into the data that we have and see what we can learn from that and see if there are ways we can manage collateral risk better. I think there are some things that show a lot of promise. One is artificial intelligence, AI, right? One aspect of AI that's really intriguing is image recognition technology. So if you provide If you acquire a set of digital photos, you can have digital is what computers can analyze, right? It's just dots and dashes, ones and twos, zeros and ones, really. So you can the artificial intelligence engine find patterns in photographs that can be applied, and this is really important because historically, I mean, all through history, up until very recently, an image, whether it's a picture or a photograph, is something that was a uniquely human endeavor to interpret.
Hmm.
So if I wanted to know, let's say every appraisal report, for example, and every property data collection report has a bunch of pictures in it. But in order to know what those pictures are telling us, you have to have a human being open the report and look at the pictures. And it has to be a well-informed human being. And manual labor is, particularly well-trained professional manual labor, is expensive, right? So what you want to do is in an economy of scarcity where the expertise to interpret photos is relatively scarce and expensive, you want a triage. You want that person to only look at the pictures that matter the most. And you can potentially use artificial intelligence to sort through this enormous number of pictures that we get and figure out which ones are the most critical from a risk management perspective. And then you can funnel those to the human being to look at, and the others you can kind of give a pass to, right? So I think that's one thing we're very intrigued with, and I know a lot of other companies are looking at that as well. And then just finding other ways to use data to assess collateral risk, to assess appraisal quality, to help inform good risk management, good lending decisions. I think the new UAD rollout is going to be huge. I think lenders are going to appreciate the greater granularity that they're going to get from that data. I think appraisers are going to learn to like it. There's always going to be a transition. As an appraiser, as a human being, learning something new is always hard.
Sure.
I think 10 or 12 assignments in, the appraisers are going to start to get comfortable with it, and then they're going to start to like it because the layout is so much more intuitive than what they do today. But I think that's going to be huge.
Yeah. Yeah, less commentary and typing paragraphs of things and more precise uh precise data capture, precise data communication. Can certainly see some opportunity there to even automate some things on the review. But even if we can't automate it, maybe that will lead to less questions in the underwriting process, which might mean less round trips of questions back to the appraiser. That would be
And
really
the questions should be more precise, right? So instead of saying your appraisal value is a lot different than we expected, your comp selection is a lot different than we expected, there's these other sales that maybe they could have worked instead. Why did you choose what you chose? Why did you do what you did? We'd rather be able to drill that down and say, okay, and maybe in one scenario, my subject property has an accessory dwelling unit. And I see that of all of these comps, you chose these two that also have accessory dwelling units. That makes sense, right? Right now, a human being has to figure that out. The machine doesn't quite get there. In the future, with better data, we could maybe teach the machine to do that kind of thing. And so then the residual, the questions are going to be much more specific. It would be, instead of saying, why did you use these comps instead of those? It could be, there are two comps with ADUs that you didn't use. Now, why didn't you use the comps with ADU? That's a much more targeted question, right?
Yeah. Yeah, super cool. Well, thanks for being here. Really appreciate having you as a guest. And
Well,
yeah. What do
Dan
you think
Keenan, it's always a pleasure. Thank you for inviting me.
of?
great to see you again.
Thanks, Lyle.